Okay, a little over 3.5 minutes to the closing bell. We're watching these markets trade higher. Let's see if we hold it. And we're going to do the closing bell with our guest today, Simeon Hyman, ProShares Advisors Global Investment Strategist, and Mike Hanson, Senior Vice President of Research at Fisher Investments. Gentlemen, thank you both for joining us. Simeon, let me start with you. You've talked about the 2022 Bloomberg consensus of 2.2% for the 10-year Treasury. What is that really going to mean, especially for the bond vigilantes?
Yeah, what it means is that's plenty high enough to hurt bonds, especially in the world where durations got really long. When rates are this low, every bond is practically a zero coupon. So the duration of the corporate ag is almost 10 years now. So, just 2.2, that's 60 bips, that's 6% that clients would lose from potential safe money. But it's not a level that's likely too big of a burden on stocks. At a 2% 10-year, you're looking at about a 20p on average historically. We were at about 23 times forward, but in the Q1 earnings season, expectations were beat by almost 25%. So at least overall, we can decompose it, but at least overall, equities could withstand that.
Mike, how are you looking at the market now? I guess, where are you seeing opportunities? Because when you take a look at the action over the last 5 days, at least, we haven't gone too far.
Yeah, I think, Shauna, you're absolutely right. And I think one of the things that's happened over the course of the last couple of months is that you've had good economic data, yes, but expectations have caught up to that good economic data. The recovery in most places of the world, especially the developed world, places like the United States, is mostly nearly done. There's still slack in the economy, but we've gone a good long way. At some point, comparables for economic data are going to become difficult. I think when you put that together with the notion that there's so much optimism about stimulus, particularly coming out of the United States. And yet, if you look back at the history of stimulus, whether it comes from actual bills or reconciliation, there's very little evidence that it actually bumps up the economy very much. And yet you put those things together with the fact that sentiment is quite high. I would call it optimistic and in some cases speculative. And so you have this world where expectations have caught up, and yet sentiment is also very high. To me, what that says is in the next 6 to 12 months, you're going to have to see a ratcheting down of expectations. My view is the world is going to return to something like pre-COVID trend growth. Right. And when that happens, it means cyclically, value stocks probably won't do quite as well as things like growth stocks, high quality, that will have higher GDP growth than most of the rest of the world.
All right, everybody on pause. We're getting ready to go back to NYSE for the closing bell. Let's take a look, though, where we stand in the markets right now. It looks like we will settle in the green. Some of the winners on the Dow today, looks like Boeing's going to be up there, up almost 4%. We talked about that last hour. Potential for even more orders of 737 coming from Southwest Airlines. So we'll keep an eye on that. Also, some of the sectors that are gaining today, we saw industrials up about 1.5%. Here we go, folks, the closing bell.
And that does it for the trading day today. Again, you're looking at gains here with the Dow closing up just around 139 points. So giving up a few of its gains here in the final couple minutes of trading. The S&P up just around 0.1%. The NASDAQ flipping back into negative territory. In terms of some of the leadership that we saw today, at least in the Dow, Boeing was the leader there, up just around 4%. Honeywell not too far behind with those shares up 3%. Walgreens there rounding out the top 3 performers within the Dow. Taking a look at the sectors, like Adam was just mentioning, industrials, materials, and financials are the outperformers today. Underperformers, technology and consumer staples. Technology, not a big surprise here as we see the NASDAQ in the red. Well, we want to bring back in our panel. We have Simeon Hyman and Mike Hanson here joining us. And Mike, let me kick it back over to you because I think there's questions out there just in terms of tech and I guess where the opportunity lies at this point. A lot of those big tech names that led us there through the pandemic have now fallen out of favor, some catching a little bit of a bid as of late. Are you seeing any investment opportunity there?
Well, I think it depends on what your time horizon is and what you're really looking at. I think that in the short term, certainly you can have things like cyclical stocks and value-oriented stocks continue to do well. But we're not in an environment where particularly the big high-quality tech stocks are in a position where they're extremely overvalued, let's say compared to past eras, or that their earnings won't continue to grow. So much of their earnings growth, in fact, especially if you take some of the big high-quality tech names, is agnostic to the notion of whether there's reopening of the economies or not, that they're going to see huge growth. And then when you put on top of that things like huge demand for tech, shortage of semiconductors that I do think will go on for at least a period of time, but will eventually resolve itself. There's still plenty of tailwinds there. What I think you want to do, especially if you're more long-term oriented, is to move away from the meme stocks, go away from the speculation, and realize that quality can really prevail in an environment like this.
Simeon, when you advise some investors, especially those who are in corporate bonds, that they're going to need to go out the curve to earn meaningful spreads, how would you advise them to hedge their interest rate risk, given what we all expect to be coming down the pike towards the second half of the year or even the first half of next year?
Sure. The answer is to hedge it well, because you made a really important point. To get any yield these days on the corporate side, you have to go at least sort of to the regular part of the curve, somewhere in the 5 and 10 year duration. The corporate curve is notably steeper than the treasury curve. So there is an opportunity to invest in kind of regular duration corporate bonds, hedge the interest rate risk. You need to do that multiple points on the curve because it can steep a little, it can flatten. You got to rebalance all the time. So there's a little bit of a challenge there. But certainly that is a space where you can profit from the beneficial aspects of credit in an improving economy, because the credit spreads will likely come in a little bit more even as treasury rates rise.
And Mike, as we talk about people looking for opportunities out there, maybe trying to diversify their holdings a little bit, of course, we have to bring up what's been going on in crypto recently. We've seen Bitcoin obviously well off the highs today, trading below 40,000. Jamie Dimon making a few comments there in front of lawmakers on crypto not too long ago. How are you viewing this just in terms of, I guess, a possible alternative here to the more traditional investment avenues?
Well, it's the speculative asset of our time. And one of the things I've read frequently, in fact, over the course of the last week or so, is that there's this correlation with crypto and particularly tech stocks. But if you look at any correlations that are longer than 3, 6, 9, 12 months, that relationship really doesn't exist. There isn't a correlation between tech and crypto. And I think that's really against what you read these days. But it's a critical moment for crypto. And I think for those who want to speculate on it, you need to be very careful because it's gotten big enough now to where government regulation is starting to creep in. See this in China with their own digital currency and, of course, starting to try and supersede other types of cryptocurrencies. But it's happening in the U.S. as well, where they're starting to talk about taxes on transactions, increased reporting, more transparency, et cetera. So in addition to all that, if you think maybe a year ahead, 3, 5 years ahead, I don't know when, there's eventually going to be consolidation. There are many, many different types of cryptocurrencies. My best guess is that many of those don't actually exist in 5 years. And so what you have to be confident in doing is thinking through which ones you think are the winners, and that's a real speculative game.
Mike, I want to follow up on something else you've pointed out as we look at the future. We talked about a $6 trillion budget proposal. We know government spending is going to potentially increase, but you've pointed out that tax increases are a negotiating topic, not a certainty. What should investors make of the fact that we know the $6 trillion budget proposal is not going to wind up being that? Should we have less concern about the huge borrowing that's going to take place and its impact on where we put our money?
Well, first of all, I think it's worth saying that the honeymoon period is ending for the Biden administration, as it does with all presidents, and that some of the very high optimism of what was going to happen is being tempered really almost by the day. And I think that that's going to continue. There's intra-party bickering, there's geopolitical tensions, and of course, there's the inflation concern that are all starting to wear on these lofty ideas. But in terms of U.S. debt, particularly in the United States, but you can actually carry this point over to many of the developed world economies. It's a question of whether they can afford the debt that they take on. And whether you agree with it or not, whether you think it's manipulated or not, the fact is long-term interest rates are low, short-term interest rates are low. And so the ability to finance these deficit levels is well within structural norms. In fact, we ran very high structural budget deficits in the 80s. That was a great time for the economy, a great time for the stock market. And in fact, if you look through the periods of history where we have spikes in deficits, somewhat counterintuitively to many people's minds, you tend to have pretty good stock market results. And so I think that's all of a piece of what we're seeing today. We certainly are going to see the debt and deficit spike. It's probably going to go to record levels, but that's different than asking the question of whether it's affordable based on tax revenue and also based on the cost of capital. Both of those things, in fact, are likely to stay within reason over the course of the next several years.
Mike Hanson, Senior Vice President of Research at Fisher Investments, Simeon Hyman, ProShares Advisors, Global Investment Strategist. Always good to see both of you. Thank you for joining us. Have a great, by the way, Memorial Holiday weekend.